Greetings and welcome to the 2014 XYZ Model Financial Statements Update. My name is Mark Hucklesby and I'm a partner and National Technical Director at Grant Thornton. And what I want to do is update you in what are the latest developments and trends that are reported in XYZ Model Financial Statements. Publication that we're jointly producing with Thomson Reuters covers all tiers of financial reporting in New Zealand, and over the next 12 months we'll cover all different types of reporting entities as well, and certainly our intention is to make it the go-to guide for dealing with financial reporting issues. In today's session, I suppose there are a few key objectives that I want to achieve. The first is to create awareness. There is a huge amount of material, in fact thousands of pages of accounting standards, so we can't drill down to each one of them during this short video presentation. But hopefully some geography will be created and you'll have some context in which to consider the financial reporting standards. I also want to provide some food for thought, and by that I mean it is what are you currently doing and what might you have to change? Or what conversations might you need to have with others in the organisations that you work with, whether it's the senior management team or those involved in governance. Because without doubt, it doesn't matter what type of reporting entity you are, the financial statements you're preparing right now will have to change next year under the auspices of the new Financial Reporting Act 2013. And what we'll do is also hope to make this session highly interactive in terms of being a video presentation. It's a chance for you to stop, perhaps go back to the technical material or replay some of the commentary in terms of how the various elements all come together. So let's get straight into the session. And I've got basically 8 points that I'd like to cover. The first deals with policy development principles in terms of creating New Zealand GAAP. What I'm really trying to do here is provide some context to the financial reporting regimes that we've now got in place. There has been changes in legislation, and a query that's often coming across my desk is where do I go to find where the changes are? So I have a few slides illustrating that. And then I'd like to just briefly recap on what's new in 2014. Whilst many sets of accounts may have already been completed, if you are in the final roll-up to completing your statutory accounts for 2014, there are just a couple of points that I wanted to highlight given their significance. And then we get to transitioning from differential reporting to RDR, the reduced disclosure regime. There are some key changes, and again what I want to do is create awareness of some of the keystone differences between the two reporting regimes. And in terms of differences, well, we've clearly got NZ-IFRS as well, and we've got PBE, the Public Benefit Entity IPSAS standards. Now, as we will find out, much of the DNA of IPSAS standards comes from international accounting standards, but there are differences, and particularly if you are an accountant that's supporting a not-for-profit or public sector entity, now's the time to get a feel for some of the major changes where the goalposts well and truly have moved between the two regimes. And like most legislation that drives us, there are deadlines, penalties and sanctions. And whilst not wanting to unnecessarily, I suppose, put the wind up at those involved in financial reporting, the fact is that the rules have changed and the attention to detail needs to absolutely be there, probably more so now than ever in the past. Now, in my role as National Technical Director at Grant Thornton, many questions come across my desks, and what I've tried to do is just bring together a series of frequently asked questions that have happened and been put to me over the last 6 months or so that again you've got an insight into the change that is really hitting the financial reporting landscape. And I'll close with some final remarks, things to bear in mind. So a pretty chocker outline, lots of detail, but let's get on with the show and work our way through. But before I go too much further, one of the things I want to put out is essentially this issue here. And it is, what is GAAP? Now, you're kind of saying, well, I'm an accountant. It's generally accepted accounting practice. But I think one of the key things that has changed is this concept of what is generally accepted. If we go back to financial reporting in New Zealand and the standards we created before International Financial Reporting Standards, there were general ways of doing things, and that got codified into accounting standards. And that was the generally accepted accounting practice in New Zealand. But with financial reporting becoming international, the paradigm has really changed. Generally accepted can't be what has always been done in a particular industry or a particular country. It has to be something that is driven from a set of principles that is refined with a set of rules, and there is explanatory guidance and illustrative examples that provide insight into what the standard setter is trying to achieve. So when the issue of what is GAAP kind of comes up for discussion, it's perhaps just recognizing that things have well and truly changed in the GAAP arena. And as I said, I wanted this to be interactive, and I've put this to some colleagues. I said, what do these flags have in common? And in light of the GAAP slide previously, well, the answer is, of course, they are all flags of the Commonwealth. And it is the Commonwealth and the recent Commonwealth Games that I wanted to kind of use as an analogy to explain at least some of the principles that we've got here in financial reporting. And this, of course, was the strap line. It was ready, steady, what? It was Glasgow, of course. And Glasgow is a city of great heritage. And it was a city where, obviously, we had gold, silver, and bronze medals. And, of course, being a person who loves numbers, how many medals were presented? Well, surprisingly, 820. 261 gold and silver, and the rest were bronze, recognising in some sports bronze is given to both third and fourth place getters. And whilst on the subject of numbers, clearly there were the athletics at Hampton Park, and the question that I've put to many is, well, just how big is Hampton Park? Well, bringing it back to New Zealand, it's virtually identical in size to Eden Park, and when chock-a-block holds just on about 45,000 people. So now back to policy development principles behind New Zealand GAAP. And I want to share with you a slide that really does, in some ways, provide a history lesson around the Financial Reporting Act. And remember, the Financial Reporting Act is important because it gives accounting standards, in particular, the force of law. So where does this story begin? Well, as you can see, we've got effectively 6 policy development principles. And in the 1993 Act, what we had were 3 very important ones, which I want to speak to first. The first one was timeliness, which is this item here. What we had with the 1987 financial crash were a whole lot of companies preparing financial statements that hit the bottom drawer, but often they weren't completed within a timely basis. So one of the key things that the Financial Reporting Act 93 did was impose some limits. For exempt companies, which would make up the vast majority of New Zealand companies, you've got 9 months to prepare financial statements. For other types of companies, it was 5 months plus 20 working days. And timeliness is trying to recognise that if you have accounts that are too stale, then they're no use for decision making. As we will see, timeliness has been tightened up in the 2013 legislation. We then had accountability. And accountability, I suppose, is reminding directors and those of governing bodies that there is collective responsibility. We see this with the public prosecutions for directors of finance companies, where it's all for one and one for all. And look, people have gone to jail and been fined, and when one approves a set of financial statements, it's not a Me Too exercise, it's one where directors need to actively ask questions and understand what's going on. And lastly, there's this concept of fairness. Now, I don't want to go into a big detailed debate on how fairness manifests itself, other than to say that when we had the 1993 Financial Reporting Act, we also had a fundamental rewrite of the Companies Act. And when there were major transactions that were put to shareholders, for example, doubling your size or shrinking your operations by more than half, and you had a shareholder resolution, if you chose not to go with that, you could get out of your investment at fair value. And where was that fair value determined? Well, it was determined from the general purpose financial statements created by the Financial Reporting Act. So you can see that there's a bit of a loop that's taking place there. So timeliness, accountability and fairness, all very much a part of the 1993 Act, and still very relevant and very alive in the 2013 legislation. But what we saw following the 2007 global financial crisis and the fall in finance companies in New Zealand were three other policy development principles coming through. The first one was public accountability. Now, public accountability, I think, is well understood in terms of issuers and the sense that if you take money from the public by way of debt or by way of equity, then you end up being an issuer. As we will see, the term issuer moves on in the new legislation, and we talk about something called an FMC reporting entity. But public accountability was also about raising money from the public in other dimensions. And perhaps the most obvious one is in the charity space and in not-for-profits. So if you are collecting funds for a charity on Queen Street, then the policymakers are basically saying, we want to see what's happening with those funds. Or if there is a telethon that raised $1 million, but in fact only $10,000 of that ultimately ends up going to the charity sponsoring the telethon and everyone else takes out their cut in terms of hosting it. Well, we want transparency. It's not saying it's wrong, but public accountability is saying, I've raised money from the public, where's it gone? So public accountability brings in the not-for-profits in a big way. It's also there, of course, for the public sector, as it's always been. Now, economic significance, again, we could talk about the debate around this, but for me, it basically boils down to this. The bigger you are, the harder you fall, and therefore, if you are large, then there's a certain amount of accountability that you have, to employees, to creditors and the like. And it's because you've got that economic, significance that you've really got to effectively build some thresholds. And we'll drill down on that. But basically, if you're large, then you've got general purpose financial rules, reporting rules sitting around you. And then I suppose for many small business owners, we've got the separation of ownership and management. Now, where do you draw that line? It's interesting that that line has been set that if you've got less than 10 shareholders, then you don't get caught by general purpose financial reporting, you can go by default straight into special purpose financial reporting. And that is important. What's also important is to recognize that if you've got more than 50 shareholders, then you automatically find yourself defined as an FMC reporting entity under the Financial Markets Conduct Act. And therefore, the number of shareholders that you have will drive certain processes, and we'll elaborate on that a little bit more in the presentation. So, to recap, 6 building blocks, but ultimately we're talking about, has there been cost-effective delivery of information that is useful for decision making to the reporting entity? And I suppose that's a mantra that I've always worked with and from ever since I got into learning about accounting and its importance. And obviously it's a backdrop against the markets and what's happening. So I suppose in summary, we've got these policy development principles giving rise to a whole host of changes. And now what we're going to do is drill down to what some of these changes are. Key changes in the legislation. Well, I've already been talking about economic significance, and I think one of the key points here is that the definition of large is for, and at this point I'll focus on companies, in each of the 2 preceding years, so it's a very hard cut-off. It's not talking about the current year, which is where our current size criteria for large are determined. In each of the 2 preceding years, have you either got total assets greater than 60 million or revenues greater than 30 million? Now, a question that was put to me just a couple of weeks ago was, Mark, I've got 1 year where assets are greater than 60 million, and then the next year where revenue is greater than 30 million, but the assets fell back below that 30 million threshold. Is that entity caught? And the answer is yes, categoric. The or in that phrase is really important. And then the significance of large really becomes important in terms of when looking at who actually owns the operation. And at the last minute, we saw Inland Revenue raising concerns with the policy officials about their visibility and I suppose oversight of overseas companies. And we've had in the media, of course, people talking about the amount of tax being paid by Facebook, Google, and some of these overseas companies that are operating in New Zealand. So what we do is we have reduced criteria for New Zealand branches and New Zealand subsidiaries of overseas companies. And as you can see, what we're talking about is total asset threshold of greater than 20 million for assets and revenue being 10 million. Again, we've got the OR test kicking in here. Now, a key point here is that when we're talking about the branch, we're talking about the overseas company. We're talking about the company. So if we've got XYZ Australia and they've got a New Zealand branch, and XYZ Australia actually has assets of 30 million in each of the 2 years, then irrespective of the size of the New Zealand branch, even if it's only $1,000, New Zealand branch accounts have to be prepared and audited under the regime because the size criteria is triggered by the overseas company. Now what we need to do is contrast that with the New Zealand subsidiary, where the size criteria of the New Zealand subsidiary, so that's XYZ New Zealand Limited, is driven by XYZ New Zealand Limited. And so you don't go looking through to the overseas ownership. The determination is solely on the size of the New Zealand reporting entity. Now, I had a killer question, and that was, Mark, what happens if you have a new branch that's created during the year, and if it's newly created, are you caught by these rules? Well, the fact is that the test is driven by the 2 preceding years. So be mindful of that when determining whether you're caught or not. And what I'm sure we will find is on the Companies Office, as they've currently got at the moment, Financial Reporting Calculator. If you put in Financial Reporting Calculator into Google, you'll find yourself in basically a walk-through decision tree that will confirm whether or not you have to report. So beware of overseas companies. Who needs to prepare the financial statements? Well, I'm not going to go into kind of a great deal of repetition here. It's large. But what I wanted to draw attention to here is that we've been talking about general purpose financial reporting, but you can step out of general purpose reporting when certain resolutions are passed. And I suppose one of the things that differentiates New Zealand from Australia is whereas all large proprietary companies have to have an audit irrespective of when they break that large threshold. In New Zealand, you can have large New Zealand companies owned by New Zealanders, but they can, if you get 95% of the shareholders supporting a resolution, they can resolve not to have an audit. So it's slightly different rules to break, I suppose, the capture and influence of audit coming across. Similarly with the companies less than 10 shareholders, again, you're actually out of the regime, you're in special purpose financial reporting, but if you want to elevate yourself into general purpose financial reporting, then you absolutely can do that. And again, the voting thresholds are established in the legislation. And there is this opting in and opting out. Again, this is really just a reminder that those are criteria established in the Companies Act. I do encourage you to look at those and make sure that within the time frames that the options are exercised, because they are quite specific. And I suppose, in terms of financial reporting, one of the things that perhaps has set New Zealand aside from some jurisdictions is that we have both parent company financial reporting and we've got group reporting. Well, one of the changes going forward as a result of the 2013 Act is that we have group financial reporting only. And so instead of having 4 columns in our financial statements and as illustrated in XYZ, we actually will only end up with 2. And interestingly, when we look at NZIFRS and that whole body of guidance provided by the International Accounting Standards Board, it was always on a group focus, actually not on a parent and group as we've had in the past. And this is, I suppose, just an APB to make you aware that if you're an issuer under current legislation, you may not automatically be an FMC reporting entity. Now, an FMC reporting entity is actually captured by the Financial Markets Conduct Act. And the key thing is that the Financial Markets Authority basically determines whether you're an FMC reporting entity or not, and also what tier you might be reporting. Yes, Tier 1 has always been associated with issuers, but Tier 2 designations are being contemplated. So, for example, retirement villages will end up being FMC reporting entities, as I understand it, but they will be designated as being able to elect to use Tier 2 financial reporting in certain instances. Obviously, the listed retirement villages will still be caught by Tier 1 reporting, but the more kind of owner-operator, privately held ones will not. And I think it's important that every FMC reporting entity must prepare its financial statements. It must be audited, and they must be filed with the Companies Office. So in that respect, it's business as usual. And certainly for the top end of town, the issuers, really the change to the 2013 Financial Reporting Act is really very minimal. But where they will be impacted, particularly the listed and those people preparing prospectuses, is that prospectuses and investment statements, as we've grown to love them over the many years that they've been around, will be replaced with a product disclosure statement, which is, in my mind, looking to standardize disclosures so that the potential investor, the MAR and PAR investor, can benchmark, I suppose, different types of organisations. So if you have the energy companies, Genesis, Mighty River Power, Meridian, and you want to kind of look across the risk profiles, then the product disclosure statements will provide some insight and a bit of a roadmap into that. So again, I think this is the right direction for New Zealand to be moving in. The regulations around all of this still being created. Be very mindful of the new requirements that come into effect for 1 December 2014 onwards. There is a 3-year transition regime built around this. The devil's in the detail. There's a great deal of excellent material on the FMA website. But I suppose if I leave you with nothing else that there's been significant change there, then that's what we need to do. So, 4 questions I think you now have to ask if you're preparing financial statements. The first is, what legislation governs the entity? Now, this might seem obvious, but as we'll elaborate, perhaps not quite as easy to answer as first thought. When does the legislation come into effect? And this is quite important because it's not kind of a one-size-fits-all. What's happening for-profit companies is quite different from the public sector and also for the not-for-profits. What's here? Again, going back to those policy development principles where there's a cost-benefit equation and we've got 4 tiers of reporting, you've got to ask yourself, well, where do I actually sit? And then last, but by no means least, if I do have to transition, what on earth do I have to do and how do I go about it? So let's look at the Financial Reporting Act and perhaps see what's changed. Well, on this slide here, we've got the 1993 Act, which all of us have studied at great depth. We probably almost know it back to front, 15 pages or so. It outlines not only what the standard setter, the External Reporting Board, has to do, but they also outlines the content of audit reports, basically defines auditor qualifications, what the filing requirements. It's basically a one-stop shop when it comes to financial reporting requirements, and that was the way it was designed. If I don't comply, what are my penalties? All in the 1993 Act. Big change, though. In the 2013 Act, what we actually find is that it's really only outlining the operations of the External Reporting Board. And hopefully you can see that there's some dovetailing into what we've covered so far in this presentation around a linkage, yes, to issue financial reporting standards, but also to issue auditing and assurance standards, set those tiers of reporting, establish large, and by no means overlooking the transition from the Financial Reporting Act 1993 through to the FMC Act of 2013. And what do I mean by this? Well, I'm a visual spatial guy, so diagrams like this kind of help me come to grips with what's happening. Remember the Financial Reporting Act, one-stop shop. We've got enabling legislation like, the Companies Act or the Unit Trusts Act or Public Finance Act that say, we've got a linkage into the Financial Reporting Act. And then, of course, we've got all sorts of securities legislation. Starts with the Securities Act of 1978, but then we've got all the KiwiSaver Amendment Acts and the like that really was, a potpourri of securities legislation pretty much over the last 30 years. So, key takeaway, that the Financial Reporting Act, as previously mentioned, was a one-stop shop. So what's changed, you say? Well, the change is that the Financial Reporting Act, having been kind of skinnied, means that now you've got to go into the enabling legislation to find out what qualifications the auditor needs to have, if any, to undertake the audit, to find out what the reporting deadlines are, what the penalties for non-compliance are, what the timelines are, etc., etc. So the devil's in the detail, but you've got to go to that Financial Reporting Amendments and Other Enactments Act, what a great name, to get to what's happening. And here we've got, yes, the humongous, but at least one-stop Financial Markets Conduct Act, which, dare I say, the entire legal profession in New Zealand and some of us in the accounting profession are still trying to fully understand and appreciate its dovetailing. But one of the key things is that effectively, if you're caught by the FMCA, that you've got to go to Part 7 of this Act to get your reporting requirements. They're not in the kind of Financial Reporting Act. So just be very mindful of the fact that FMC reporting entities, you end up with kind of a one-stop shop guidance there. So, where have we come from? Well, basically, Kiwi GAAP or NZ GAAP until 2013, we're all very familiar. NZ GAAP, two regimes, old Kiwi GAAP, NZ IFRS, with a differential reporting regime that was really designed to reduce the time and effort to complete statutory accounts. Good stuff. Where have we moved to? Well, as you can see, new limbs emerging. And I suppose one of the key things is that the change starts with a public benefit entity. And the question is, are you a public benefit entity? And only if the answer to that is no, then you end up with the for-profit regime. And there's a lot of guidance material about whether you are a public benefit entity or not. So if you're preparing financial statements and you do have commercial operations, you really do have to ask yourself whether you're in that space or that space. And it becomes far more complicated when you've got a group situation. So if we take Auckland Council, yep, they're running, a $1 billion operation in terms of the people here in Auckland, but also they own an airport, which just happens to be listed, and a port company, which is also for-profit. And so we've got this mixed group. And one of the things that we need to be aware of is that there is guidance around mixed group reporting. And it's in the guidance that's been issued by the XRB. And if it's applicable, you need to kind of get into that material. So from the public benefit entity definition, we end up with IPSAS, these International Public Sector Accounting Standards that have been adapted for public benefit entities here in what I call the public sector here. We've got not-for-profits, and they've been adapted, really just terminology and a few more illustrative examples just to make sure whether what's in IPSAS is applicable. And then NZ IFRS is really, we've always loved it. But reduced disclosure regime. Now this is not differential reporting, this is simply reduced disclosure. And so that means when we get into recognition and measurement, whether we're in full IFRS or in RDR, it's the same. And for that means changes. That means cash flow statements will have to be prepared. Deferred tax will have to be done. And we'll bring that out in slides shortly. So, as someone rather cynically put to me at a recent presentation, Mark, what hasn't changed? And I'm hard pushed to actually answer that question. It's a bit of a marshmallow. Everything is changing, and what we've got are these 4 tiers. Again, you can get details about these tiers, the regime, and I really would encourage you to go into this book for guidance, or alternatively go to the XRB website, which will really illustrate the tier 1, tier 2, tier 3 differential reporting, which is around effectively only for 1 more year, tier 4, which is also around for 1 more year. Now, the key is that given the XRB financial reporting framework, for periods commencing on or after 1 April 2015, there absolutely is no way that you can adopt differential reporting or old Kiwi GAAP. However, what we have seen in recently is an amendment to the XRB framework, which allows differential reporting and old Kiwi GAAP to be used in 31 March 2015 financial statements. And the reason for that extension is because if you are in tier 3 and tier 4, and you have to step up to tier 2 because you are large, you've got to get comparative information. And that needs to be basically done on a prospective basis. So whilst the original intention was for periods on or after 1 April 2014, you must be adopting the RDR regime or full NZ-IFRS for companies. We have had this slight concession. Again, the devil's in the detail. There are full details on the XRB website about transition. But this is, effectively what we're left with. Tier 1, financial reporting entities, basically business as usual. Tier 2, which means that you've moved from differential reporting probably into RDR. And then we've got special purpose financial reporting, where guidance is not issued by the External Reporting Board at all. It has been picked up by the New Zealand Institute of Chartered Accountants, or now Chartered Accountants Australia and New Zealand, and CANS has effectively provided the rulebook for special purpose reporting. Perhaps I've used the wrong word there. I said rulebook. It is actually guidance, so it's leading you to a way of doing special purpose financial reporting. It provides a framework and a benchmark for reporting, but it is voluntary. There's no compulsion in terms of having to use it. Now, I've been talking about these dates, and whilst these dates here are what was originally intended, and certainly what I'm encouraging all my clients to transition to, the fact is that 31 March next year is probably the right date to be transitioning to the new regime. When we look at not-for-profits, however, you'll notice that there has been a delay. We're talking about 1 year delay, 2016. That's so that you can get your comparatives. And in fact, this is effectively the time frame for transition if you're a tier 3 or tier 4 entity, as I was just previously explaining. And sorry for all the permutations and combinations, but that's the world that we live in. And certainly, I suppose, my mind has changed in terms of going back to the source material because, as I say, so many variables have moved. So let's take a break for a moment and just pause, and let's just look at what's happened in 2014. A big year because many new standards came into effect. And I suppose one of the key things is that we had an amendment to IAS 1, and it was disclosure around the recyclable components of other comprehensive income. And I've got a slide here that will kind of illustrate what's happening. In other comprehensive income, as you can see here, what you have to do is actually break it up into two headings. Those items that will not be reclassified through profit and loss, and here we're talking about revaluation of land or remeasurement of defined benefit liabilities, as opposed to other items which would be in other comprehensive income, which when they mature or are sold, there will be a recycling of that balance back through the income statement and profit and loss. So, for example, cash flow hedging balances and any gains or losses on available for sale assets, if they've been designated that way, those gains will end up being recycled. So a small point, but it's a clear change in amendments, and if you have other comprehensive income, and I would say probably a quarter to a third of the financial statements that I review have this component, then this is an important change to take place. Then we've got disclosure of what tier of reporting you're in. Because the XRB is in place, it's important that we recognise what tier you're reporting. And if we go to RDR, illustrative financial statements in under checkpoint, we'll find quite specifically here we are a tier 2 reporting entity for the purposes of preparing these financial statements. And again, an important disclosure that needs to be made, often being looked in the sets of accounts that I've been asked to review. Now, it's important to realise that in 2014, even though we've had new accounting standards coming into place, that you can elect to basically not reflect these changes in IFRS that have come about. So that's these standards here, 10, 11, 12 and 13. You can effectively freeze, and as long as you say, well, I'm not taking account of these new standards coming into effect in for periods beginning on or after the 1st of January 2013, and you're away. Public benefit entities, actually have no choice. They are required to ignore these new standards coming in place. Why? Because we'll just go straight across to the IPSAS standards, and we'll talk about that in a moment. So, big picture, again, bit of a flowchart here illustrating how IFRS 10, 11 and 12 kind of fit together. May have seen variations of a theme, but let's work our way. We start at the top with control. And remember that the definition of control has changed. So often do I see in accounts controlling the operating and financing activities. Well, actually controls a lot more than that in IFRS 10. If the answer is yes, you go into IFRS 10, you'll then be caught up with the disclosures in IFRS 12, and you'll go forward from there. But if you've got control or don't have control, you've got to then ask yourself, well, do I have joint control? Let's say a 50-50 operation. And again, you come to a decision tree, and you've got to ask yourself, well, what type of joint arrangement do I have? The definitions are in 11, and I suppose the key thing is, just because you've got a joint venture and a separate incorporated entity doesn't automatically mean that you're heading down the equity accounting rule. So be mindful of that, but more importantly, notice that if you do go down that route, proportionate consolidation is now banned. So that's probably one of the key changes in terms of IFRS 11. And then kind of coming down the side here, if you haven't got joint control, have you got significant influence? Again, we've been working with nominal thresholds of 20% of the shareholding. So if we find ourselves saying, no, we don't have significant influence, let's say we've got a 10% interest in terms of an investment in a private company. Well, where this is heading us to ultimately is NZ IFRS 9, the financial instrument standard. And what makes that so significant is the fact that IFRS 9 will require you to fair value that 10% interest in the equity shares of a private company. The fact that it's too hard is just not accepted by the accounting standards. Now, the gains and losses on that can go to OCI or direct to P&L. That's an accounting policy choice. And today's presentation is not to look at all the gory details behind IFRS 9. But just be mindful of, I suppose, this overall architecture that we've got here. So, 10, and I put these slides up really just to give you a flavour of the change. We've got basically widened, I suppose, sense of what should be consolidated. Bear in mind, in New Zealand, we've always had a strong substance over form. In Europe, it was very much 50% you consolidate, above 50%. Below 50% you would never consolidate. Well, the accounting standard changes that, and so you can have a 48% voting interest and consolidate. Similarly, you can have a 53% interest and not consolidate. Obviously, disclosures would be around that. But that's what this standard's all about, and it is around, do I have control over the other reporting entity? 11, again, this is really trying to perhaps standardize practice, get clearer definitions based on the way that the old standard, which was 31 on joint venture accounting, was being interpreted. And again, we've got control being aligned with what we saw in the other standard. And we've got these terms of joint control, joint operation, joint venture. Very important to recognize those, and if you are caught by this, that you're changing your accounting policies to reflect these changed definitions. 12, well, what makes 12 different, I suppose, is that it's a one-stop shop. Whether you've got subsidiary, joint arrangement, associate, or unconsolidated structured entities, the most important thing to bear in mind is that the same disclosure regime applies. So you can't effectively arbitrage your disclosures according to the ownership arrangements that you have. And I suppose the key thing here is that the objective is to provide sufficient detail to basically understand the significance of those investments in the overall group perspective. And this slide here is really trying to emphasize, as you can see in the red letter, that you have to provide significant amount of quantitative data when, and effectively only when, judgment has been exercised that you have got a material non-controlling interest or a material joint venture. And it is that focus on materiality, a professional judgment issue made initially by management, reviewed and confirmed through the audit process, that brings out this much fuller disclosure that IFRS 12 has coming forward. So I suppose my mission is to say, be careful out there. Just because these new standards have come in place doesn't mean that the wording, particularly in the accounting policy, should remain unchanged. And again, in the XYZ model financial statements, we've got some amended wording there. And plug here, if you don't want to wade through all the standards, if you go onto the Grant Thornton website and you look under IFRS and publications, you'll see that we've got something called a special edition. And what this does in 16 pages is essentially summarize these slides that I've just been through on the consolidation standards. We've also got a special edition around fair value accounting. And again, this here is to recognize that fair value is such an integral component of IFRS reporting that there needs to be some consistency in the way that it's measured and reported. And again, is a standard which has really highlighted, for example, in banks, and particularly when there are receivables, that you've got to account for the credit risk associated with the financial instruments that you've got. So we've got CVA, credit value adjustments, DVA if it goes the other way, and these need to be built into the determination of fair value, which is built from really the third party perspective, not from the reporting entity's perspective. And really the purpose of this slide and the two or three that follow is really to bring out the fact that IFRS talks about fair value in many, many ways. IFRS 1 in terms of transition and deemed cost, 2 on share-based payments, 3 on business combinations with that whole purchase price allocation built around fair value, non-continuing activities through IFRS 5, and then we get obviously to the gloriously complex world of financial instruments with 39 and obviously the new IFRS 9 coming through. It doesn't stop. Next page, we kind of go to construction contracts, again fair value, property, plant and equipment. Again, it's a permission to use the revaluation model, not a requirement. Bear in mind that. 17 with leases, 18 with revenue recognition, and so it continues. Even with government grants, the fair value of donated items needs to be kind of recognised. And so it continues through these standards, which we've just been talking about, IFRS 11, impairment, of course, and so the list goes on. And I think that this is really kind of a key point, that fair value and the need to spend sufficient time making sure that they are appropriate is absolutely fundamental now. And I suppose IFRS 13 puts the real nail in the coffin. So to repeat, an incredibly important standard, has a lot of material. Beware of the level 1, 2 and 3 inputs and the level of disclosures around it. Dovetails very closely into IFRS 7 in terms of financial instrument disclosures, but it's really, really important. And I suppose, in terms of fair value, there are just a lot of questions that you need to ask before you can perhaps finally determine that you've got the right solution and the right disclosures in the financial statements. I mean, what is meant by an active market? Because that gets you into level 1 disclosures. What market is used? Is it the wholesale market or the retail market? What pricing are we using? Are we using entry, bid, mid-market? And what is the effect of own credit risk? Recognizing the peculiarities that you can make income when your credit declines. Or, should in fact fair value take into account that I've got a controlling interest or a blocking ownership? That would mean that if I was to take it to market, I would get a premium, etc., etc. And what are the characteristics of that market participant from whom that perspective of fair value is coming? So, look, more questions than answers, but I suppose highlighting the complexity of properly applying IFRS 13 and the need to go forward. So, in summary, it's a big standard, and a lot of companies, and I think I'm seeing in the listed companies that have reported and filed so far, a lot of good disclosure. And look, it is evolving. New Zealand is closely mirroring what I'm seeing in Australian and UK multinationals that are also reporting under IFRS. But at the end of the day, if you have to apply this standard, it is important that it's followed in its entirety. So that's a lot to consider. And at this stage, if you're watching this, perhaps you might want to have a stretch break. I don't necessarily encourage you to do this amount of exercise, but we'll come back shortly to continue with this update on XYZ model financial statements and what's happening.